And we are now recording the meeting. So Tim, I will turn it over to you.
Thank you, Patty. Okay, first item on the agenda is call the meeting to order. It's 9:05 a.m. Who is taking minutes? Is Donna?
Yes, I am.
Okay, thanks, Donna. Do you have an attendee list that you can include with that? So we don't have to do a roll call here, because I think we just did that.
Yes, I do.
Perfect, thank you. All right, first real item on the agenda is the approval of the minutes from the May 19th, 2020 meeting. Can I get a motion to approve the minutes?
Motion to approve.
Thank you, Elliot. Can I get a second?
Second.
Thank you, Craig. Not everyone at once. I know this is the thrilling part. Are there any addenda corrections or anything changes that need to be made to the minutes that anyone saw? Okay, hearing none. All in favor of the minutes as presented, say aye.
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 Any opposed? State your name and that you're opposed. Minutes are unanimously passed. Next item on the agenda is update of the DeMayo Schneider FIA merger. I guess I turn it right over to you, Devin, for most of the rest of this.
That's right. Yes. I hope the tone of my voice will not put you to sleep or annoy you. So yes, the merger is going well. Just to give a bit of background for folks that may have forgotten about what's been happening earlier this year, which seems like a million years ago. So early in 2020, we announced that we would be merging with kind of a sister firm out of Chicago, DeMayo Schneider and Associates. DeMayo Schneider covers all of the exact same lines of business that FIA has historically covered. So pension plans, 401k plans, 403b plans, endowments and foundations, private wealth. So everything that we have always done, they do as well. Our founder, Mark Wetzel, our founder and president, has known Bob DeMayo Schneider's founder and president, for over 30 years. They used to work together at UBS Financial Services. When Bob left in '95 to begin DeMayo Schneider and Associates, he and Mark kept in touch. They had a quarterly call on the calendar. And then that became even more important when Mark and his whole group left UBS in 2006 to begin FIA. So the two firms were really developed along very parallel paths. We have, again, the same business lines, a lot of the same service team structure, the same priority of course, keeping our clients happy above all else. So all of our core values were really closely aligned. So that was the genesis behind the integration, because Mark is getting close to approaching retirement age. He is a very significant percentage owner of FIA, and so we needed to build in some sort of succession plan. So we had 17 partners at FIA. DeMayo Schneider had 13 partners. Our chief operating officer, or who has historically been our COO, will be retiring at the end of this year. So her partnership dropped off. We now have 30 partners between the two firms. We have an executive committee between that is comprised of both folks from the FIA Windsor office and then also from the DeMayo Chicago office. So essentially equal representation from both FIA and DeMayo on the executive committee. And the executive committee is the group that's charged with really day-to-day oversight of the firm. So the integration has been going very well. I think actually COVID has been kind of a blessing in disguise, because whereas typically consultants are out on the road 3-4 days a week, planes, trains, and automobiles meeting with clients, we're now all home in front of our computers all day. And so it's allowed us to really focus on the integration without having travel, kind of disrupt things. And also, I think one way that it's been beneficial is that there is not an us versus them mentality. I think, of course, we would have tried to avoid that anyways, but because everyone is just a little tile on the computer screen, It's not a case of, a bunch of us in the Windsor office around a conference table talking with a bunch of folks from Chicago around their conference table, and they're, are two distinct teams. It's, I think the fact that we're all kind of operating independently in these little satellite offices has actually been very helpful. So we do have a what's called the business council for each line of the business. And so there is a specific business council for our public fund work. And of course, that's primarily pension plans. And also defined contribution plans within the public space. So there is a dedicated group of folks that meet on a regular basis, and that's what they're talking about is strategy and trends in the marketplace and, specific client issues that may come up. One of the things that when I first mentioned the firm integration, the big takeaway was that nothing will change for this town of Stonington. I'll continue to be your consultant. I was a partner at FIA. I'm now a partner at DeMayo Schneider. Nothing has changed from that perspective. But one of the things that I think will change, but in a positive way, is our manager research structure. So we have always, our manager research group has always been kind of a point of pride of FIA, a very deep and well-credentialed team that is magnified quite significantly based on the merger with DeMayo. So we previously had 9 folks that were dedicated to manager research, spent all of their time doing manager research. We now have 21 individuals between the 2 combined firms. We have both asset class specialists as well as generalists. So for instance, we have an individual that will focus on the credit areas of the fixed income markets, but then we also have generalists that cover kind of exposures really across the asset class spectrum. So that allows for a lot of depth and breadth and a lot of expertise when it comes to manager selection. What the manager research group is focusing on right now is culling down our list of preferred managers. So as you know, but I'll just give you a reminder, we are completely agnostic when it comes to manager selection. Managers do not pay to be included in our database. We receive no commissions or soft dollars or any compensation of any sort by using managers. So of course that structure has not changed. But between the 2 firms, we had lots and lots and lots of manager strategies that have been on our approved list and have been used in client portfolios. So what the research group is doing now is trying to cull down that list and think about the managers that are really our true best ideas, the best of the best in each particular asset class. And the reason that I bring this up is because as we work through that process, it's possible that I may be coming to you with some recommended changes. Hey, the manager XYZ has been on our approved list. We've decided to move away from them in favor of, choose from these 3 other strategies. So in that way, your portfolio may be impacted, but of course, I'll continue to come to you proactively. There will never be, based on this process, there will not be a fire drill type situation like, oh, we got to get out of this strategy right away. That fire drill situation may occur because of some outside factor. For instance, when Bill Gross left PIMCO, that was the scenario that we were faced with, where we wanted to exit those strategies immediately. But based on this process of culling down our list of preferred managers, we don't expect any urgency, but it may result in some recommended changes to your portfolio lineup. But other than that, we've been thrilled to be working with the folks from Chicago. They are very bright, very welcoming, and I think they would say the same of us. I think that we now have a lot more content to offer. So you'll be seeing things on a more frequent basis in terms of newsletters and webinars and all sorts of informative and educational content. So we are thrilled with the merger so far, and knock on wood, we haven't hit any bumps in the road. So happy to answer any questions that any of you may have.
Thanks, Devin. I'm sure you've gone through that countless times over the last few months, so appreciate that. And I view good news, particularly from the research side, with additional resources and increasing the depth of that team. So appreciate the update.
Great, thanks, Elliot. Good suggestion to add it to the agenda.
Any other questions from anyone? Nope. All right, thanks, Devin. Moving right on to a review of the capital markets.
Okay, wonderful. So I'm just going to, if it's okay with you, I will kind of plow through the next two agenda items. So the capital markets and then the review of the DB plan, and incorporated within that will be the governance calendar. I'm going to actually try to be pretty brief about the DB plan, because I think that where I'd like to spend the bulk of my time today is on the DC plan review. Of course, happy to dive into anything in more detail if you feel that I haven't covered it adequately, but I'm going to kind of be pretty brief in my DB comments and then turn it over to Stefan for the actuarial piece. So let me see if I can share my screen. And here we go. All right.
Oh,
Can
perfect.
folks see this? See the cover page right now of the third quarter report? Okay.
Yep,
Great.
no problem.
Yep.
Wonderful. Let me just make a couple adjustments on my side. Okay, so the first section of every quarterly report is the governance calendar. I'll go through this quickly. This is just a review of the municipal landscape. So here on slide 6, you'll see the average funded status and the discount rate across the state of Connecticut. So what are other municipal plans doing? What discount rate are they using? How healthy is their funded status? So your plan, as you'll see, based on the 2019 valuation, and then of course Stefan is, has some things to discuss in order to come up with the 2020 valuation. But your plan is about 89% funded, so you fall here within the 80 to 90% funded status. So, and you're at the high end of that. So very healthy funded status, particularly relative to other municipal plans in the state of Connecticut. And then what I think is actually that you're using. So you have moved your discount rate lower in recent history. It currently sits at 6.5%. And you can see the comparison to other municipal plans on the right-hand side of page 6. So what I think is really staggering is that if you look back just 5 years ago, 60% of plans were using a discount rate of 7.25 or higher. So that means that their actuaries were factoring into their valuation metrics an expectation that their assets would return 7.25% or more. That's a pretty high bogey. So you can see that discount rates have become more reasonable over time. They have trended downward, and now only 20% of plans are using a discount rate of 7.25 or higher. Essentially, no one across the state is using a discount rate above 8.25, so that's good. And you'll see that the vast majority are below 6.75. You fall here in this gray category. So this category covers between 6.25 and 6.75. You're right at 6.5. So you fall here within this group. And you can see that this gray bar has increased over time. So whereas 5 years ago, very few plans had a discount rate as low as yours or as conservative as yours. That has increased as the higher discount rates have decreased. So certainly we feel that municipalities broadly are moving in the right direction of becoming more conservative and really what we think is more realistic with regard to the discount rate that's being used. So you are kind of, I would say in the trend setting category. you have historically been a bit more conservative than many municipal plans, and you're, continuing to move in that conservative direction. So we think that you're doing a great job from that perspective. Any questions about any of that? Okay. All right, and then this just shows the funded status over the last 5 years or so. And again, this is broad municipal pension plans in the state of Connecticut. This is not the town of Stonington particularly. So you'll see that the average return of plan assets has been pretty volatile over time. So you have 1 year of 14.5% return, 1 year negative 10 basis points. So there's a fair amount of volatility over time. Over the past 5 years, 6 years, the funded status has, been within the corridor of, 78% to 70% or so. It's bounced around, but most recently ended with an average funded status of about 75%. Again, you are at about 89% as of the last valuation. So certainly much more healthy than the average plan in the state of Connecticut. So again, well done. Page 8, I won't spend much time because I know that Stefan is going to be talking about some of these numbers, but again, 89.6% funded as of the last valuation, a 6.5% return assumption, and then you can see the actuarial value of the assets compared to the liability. So any questions that I can address, answer, any concerns? Okay. All right, so that covers it for the governance calendar. I'll move on to the capital markets. This information seems very stale because we're now at the beginning of December and this goes through September 30th. So suffice it to say that the third quarter of the 2020 calendar year was quite a strong one for markets. If you look here on this page, let me see if I can, when I do this, is this getting bigger for everyone? Okay, great. So if you look down the column, the third quarter column, you can see very strong returns across the board. But what I think is really important is to look at some of the divergence in returns on a year-to-date and 1 year basis. And the reason that I want to bring up this divergence is because it has had an impact on your portfolio with some of the tilts that we have in the pension portfolio. So for instance, if we look and compare large cap stocks to small cap stocks, on a year-to-date basis, the S&P 500 index is up 5.6% through the end of September, whereas the Russell 2000, which is small cap stocks, is down 8.7% through the end of September. So that's a very wide dispersion in returns. And then it's even wider on a 1 year basis. The S&P is up 15.1%. The Russell 2000 is up only 40 basis points. So that's large versus small. Then there's an even greater disparity if we look under the hood at growth versus value. So the Russell 1000 growth index up 24% on a year-to-date basis, whereas the value index is down almost 12%. And then on a 1 year basis, the growth index is up 37.5% and the value index is down 5%. So more than 40 percentage points of dispersion between growth and value. That is a huge amount of dispersion. And the reason that I bring that up is because it's not really so much a case of large versus small or growth versus value. It's really a case of 6 technology stocks versus everything else in the investable universe. So if you stripped out 6 tech stocks, the FANGM stocks, so Facebook, Amazon, Apple, Netflix, Google, Microsoft. If you took those 6 stocks out of the S&P 500 index, on a year-to-date basis through the end of September, the S&P would actually have been negative, would have produced a return very similar to that of the small cap index. So it's not really that large cap stocks as a whole have performed very well. It's that these this concentrated basket of stocks, which actually represents almost a quarter of the S&P 500 index, those stocks have performed very well and have dragged kind of the whole index with it. But if you strip them out, Large cap stocks don't look that great. And then it's the same scenario with the growth versus value. The growth index is very heavily weighted towards technology. More than 40% of the index is in tech stocks, whereas the value index has a much smaller weighting towards tech and has a higher weighting to financials, energy, other areas of the market that haven't performed as well. So the reason that I bring that up is because, I think a lot of folks are, when we see dispersion this wide, when we see concentration in a certain index that's so significant, I think it can, a bit of fear of missing out can come into play, and folks might say, hey, look at the performance over the past year. Why am I even invested in small cap stocks? They're not doing anything for my portfolio. They're inherently a bit more risky. I want to pile into the large cap space. Typically when you start to see a broad group of investors have that kind of shift in mindset, that tends to be the wrong time to make a switch. And actually, it's really worth noting, I think, that so far in the fourth quarter, so throughout the months of October and November, we've seen an exact flip in these trends. So small cap has significantly outperformed large cap over the past 2 months. The small cap index is up 22% for October and November, and the large cap index is up only 9%. And value has substantially outperformed growth. So the value index quarter to date is up over 13%. The growth index is up about 7.5% or so. So we've seen a shift in this trend. Another thing that I think is worth noting is within the small cap universe, and this is not something that can be seen on this screen, but within the small cap universe, a lot of active managers have struggled because the small cap names that have performed the best have been the names that are the most expensive and that have exhibited no profitability. So typically when you have active management, and we do have active management on the small cap side on both growth and value, when you have active managers, even if they are a growth manager, they still factor price into their investment process. They still want to see evidence of profitability, not just speculation of the ability to turn a profit down the road. They want to see historical profitability. And so the stocks that have really led the markets in the small cap space have been unprofitable and have been the most expensive. So those are the types of stocks that our managers are going to avoid. And so simply having small cap exposure over the past year has been a headwind. And furthermore, having active managers who pay attention to valuation, who pay attention to profitability, that's been even more of a headwind in the small cap space, looking, over the past 9-12 months. Going forward, we think that, it's likely to be a benefit. Again, value has outperformed growth, so paying attention to price has been beneficial over the past 2 months. And we think that will likely continue going forward. And then just one final comment about growth versus value. Value stocks are, historically tend to outperform when you have an accelerating economy and when you have rising inflation expectations. That is the type of environment that we expect to be in next year when a vaccine comes to market, when activity picks up, when kind of people get back to normal business. And so we do expect that value stocks will begin to outperform going forward. And of course, you do have the value bias in your portfolio. So we think that, you're likely to benefit from that. That value bias has been a headwind when we look back over the past couple of years, but we do think that we're entering an environment that will be beneficial for value stocks. So that's basically all I wanted to touch on in the capital markets. Again, I'm happy to discuss anything in particular, but there is, again, this information kind of seems pretty stale since we're now sitting in December. And this is 9:30 information. Are there any charts or things that you'd like me to dig into before we talk about the portfolio? Okay, hearing none, I will move ahead. Page 21 shows a snapshot of the portfolio as of the end of the quarter. So we ended at just under 36.6 million. And just as a reminder, what we tend to do is raise money for 3 months worth of pension payments and set that aside, draw it down over the course of that 3 months, and then we'll replenish it. So you can see we do not have a target allocation to cash. As of the time of this report, the cash balance was at 1.9%. And again, because that had been set aside for pension payments, depending on the point in time when we've raised cash, when the report is run, that, you know, we wouldn't expect to really see a higher number than this 1.9%. But I just wanted to point out that this cash that's been set aside is designed to cover pension payments. So other than the overweight to cash and relative underweight to fixed income, everything else is just about in line with the target allocation. We think that the overall structure of the portfolio, it remains appropriate. So given your 6.5% return objective or actuarial return assumption, this overall asset allocation makes sense. The split between domestic and international equity, I think, is something that we've discussed in recent meetings. We think that this allocation continues to make sense. So you do have a bit of a home country bias. You have a 35% allocation to domestic equities and a 25% allocation to international equities. This is in keeping with what our other municipal pension plans, with how they are allocated. For some committees, this can be kind of a head scratcher. They say, why do we have so much in international? And of course, international stocks over the past 10 years or so have lagged domestic stocks. Looking forward, we think that valuations within the international space are very attractive. One of the headwinds for international stocks over the past 10 years has been the strength of the US dollar. That strength has been abating, and we expect it to continue to abate. So the US dollar is not as strong as it has been. So that headwind is kind of going away. And then we think that having active management within the international space, if you look historically at the best performing stocks across the investable universe, in all of the last 10 years, the average, on average, about 75% of the best performing stocks have come from overseas, even in years when the US substantially outperforms international markets. So what that tells us is that active managers in the international space have the potential to uncover these stocks that are likely to outperform and provide that alpha above the benchmark. And you do have quite a bit of active management within the international space. So Lazard, Templeton, and Harding Loevner are all active managers. So we continue to think that this split between domestic and international equities makes sense. It is essentially reflective of the global opportunity set. So when you look at all of the stocks in the investable universe, about 55% are domiciled in the US and about 45% are domiciled overseas. You have about that breakdown. I think yours is about 58. If we just took the equity piece as a whole, your equity exposure is about 58% domestic and the remainder about 42% international. So you are broadly speaking in keeping with the global opportunity set. And then finally, we have the real assets component. So this is designed to provide kind of an uncorrelated return stream. So it's a 5% target allocation. Under the hood, the principal fund has exposure to tips, commodities, real estate, infrastructure, natural resource equities, kind of everywhere that you might want to be invested in the real assets market, this fund has exposure. And it has the ability to overweight and underweight certain areas based on the opportunities. So we think that, broadly speaking, the portfolio is well structured from an asset allocation perspective. As I mentioned, we are going through that exercise of culling down our list of approved managers. As of right now, all of the managers in this portfolio are on maintain status. So there are no recommendations for changes at this point, but it's possible we could come to you with some recommended changes going forward. So I'll just make a few comments about performance and then open it up for questions. So on page 23, you can see the performance right in the middle of the page. So for the quarter, the portfolio was up 5.5%. It was about 60 basis points ahead of its benchmark. So very strong performance in both absolute and relative terms. On a year-to-date basis, the portfolio is up only 0.2%. And the benchmark is up 1.9%. So you see some pretty significant underperformance on a relative basis. So what's going on with that? Well, that goes back to those headwinds that I talked about on the index returns page. So the fact that we have this, the value bias, so we have a distinct value allocation. It's 5%, so it's not a huge bet in the side of, in the direction of value. But if you recall the index returns page, over the course of the past year, growth has outperformed value by about 15 percentage points. I'm sorry, much more than that, by more than 40. The 15 percentage points was large versus small. So if you have growth outperforming by more than 40 percentage points, having just a 5% modest allocation to value has been a real headwind. So that's a big portion of the relative underperformance on a year-to-date basis. And then we also have the dedicated small cap exposure and the active management within small cap. So specifically, the Eaton Vance Atlanta Capital Fund has substantially underperformed its benchmark. That's the small cap growth strategy that you have within the portfolio, but it's growth at a reasonable price. So they're looking at valuations, they're looking for evidence of profitable companies. And again, it's been the least profitable, the most expensive companies within the small cap space that have driven returns. So you've got relative underperformance because of simply having small cap exposure versus large cap. And then by having that active manager with a valuation component within the small cap space. If we look at absolute returns over the past, 5-10 years since inception, the 5-year annualized return of the portfolio is 7.2%. On a 10-year basis, you're looking at 7.1%. And then going back all the way to the inception of the plan, you're looking at an annual return of 8% per year. So if we think of it in terms of your 6.5% return objective, you are meeting the objective and making steps towards fully funding the plan. So again, we don't have any recommendations for changes at this point in time. If we do have manager recommendations, swapping out a certain strategy, we'll bring that to your attention and either discuss it at the next meeting, or if it's something that we think is more of a timely issue that we need to address right away, I would come to you in between. But I don't anticipate that that there will be any urgent changes to be made. So any questions about any of this? Do you want me to dig into any of the managers more specifically, or should we turn it over to Stefan?
Anyone have any questions? Elliot?
Yeah, just a thought or an observation on Atlanta Capital. I think we brought them up last meeting. I've known them pretty well for close to 15 years and thought very highly of them. Less concerned about quarter or even year-to-year performance. I think the magnitude's a bit alarming. but I'm comfortable that what they own in the portfolio are better businesses that just aren't being rewarded. But perhaps just a suggestion to keep a closer eye on them, given the magnitude. It's like I said, it is a bit surprising, but I think forward looking, just reaffirming that nothing under the hood's going on there. But again, I've always thought very highly of them as a firm.
Right. Yeah, thanks, Elliot. And it's good to have your perspective as someone who is in the field. And, you know, a lot of times you can look at relative performance and universe rankings, and it can be quite alarming. And so it's good to hear you share, oh, you understand, you've thought highly of them, you understand the process, and their style has been out of favor. You're right, the magnitude has been very significant. The percentile ranking is terrible. It makes sense when you think about the type of environment, but yeah, they are a manager that we talk about at every watch list meeting. They have not been placed on watch yet because the performance does make sense based on their process. But of course, you know, when you have to factor in opportunity costs, and when we're using them, that means that we're not using another manager. And so it certainly is something that is on our radar screen. We spend a lot of time talking about them. So I'll definitely alert you if that status changes, or if we think, you know, we just can't abide this relative underperformance any longer, even if their investment philosophy is sound. You know, we don't want to stick with them anymore. I'll be coming to you with ideas if we get to that point. Any other questions? Okay. I'll put myself on mute, and
I will also, just to let you know, Gary had to drop off. He had another meeting. He let me know ahead of time. He is going to try to dial back in, but he had to drop off, I believe, around 9:30. So let me try to change. Okay, I think I have turned it over.
Yep. Look at you, Patty.
Hey, my tech skills are never
WebEx
ending.
genius now.
Hey, I did do a dry run of this, Tim.
I figured.
Okay. All right. Is that on the screen now? Does everybody see the presentation? I hope.
Yep.
Yep.
Okay.
Stefan.
All right. Mine will be a little quicker than Devin's, but we will typically focus on a few things. This is really the preliminary results. We usually use this meeting to kind of decide ultimately what ultimate assumptions we're going to use. There's a couple key ones that we always kind of focus on, that being the mortality table as well as the long-term discount rate that we're using, which is currently at 6.5%. So first we'll go through some of the basic plan results under a couple different assumptions. I'll kind of go through quickly what the asset returns did, how we smooth them for the pension valuation. Then we'll kind of delve in. I think we'll spend most of our time talking about the assumption changes, or any that we will make or should make, because those always kind of, there's a fairly large range for where your ultimate contribution could be. So that's always kind of what we'll kind of focus on. We'll briefly touch base on the Hooker and Holcomb public sector survey results. Devin gave you some kind of information that was very similar to what we do. We look at all the CAFRs, that we have once they're all done. So the last time that would have been in 19. That's usually, most plans find that very useful information, because it kind of compares what you're doing compared to your peers. So it's always a nice thing to look at. Okay. So quickly, this should say the 20 valuation review. Last year you had some pluses and minuses of what the plan did last year. On the asset side, it was not very pretty. Remember, this is a snapshot as of 6/30, and so the market was kind of, if you recall, going up and down from probably February on until even now. Right now it's been kind of a large run up. As Devin said, your assets are over 6.6 million or 36.6 million. I believe they were here in the range of the 34 million at the time. This time, so your return on a basis is only 0.5%. And that. And an actuarial basis is 4.5. So we're assuming 6.5. So there were some substantial losses due to that. I think in the 650,000 range. So that was on the bad side. On the good side, down that did receive some liability gains that kind of offset some of those asset losses. There were gains due to mortality experience. So you had more deaths than we expected. That's a bad thing, but you do get gains from that, as well as salaries didn't go up quite as much as we would have expected. And so you had quite a few gains that helped offset that. 1.2% was about a total of about maybe 470,000. So you had a net loss probably to the plan of a couple $100,000. One of the key assumptions we'll talk about in the second bullet point is to update the mortality, assumption. Typically, a few years back, the Society of Actuary does an improvement scale every year, starting from 2014. So every year there's been a new one. And last valuation we used the MP 2019. This year we'll use the MP 2020 improvement scale. That gives you a little bit of a decrease in liability, because ever since they put it out, there's always been a tick down, kind of a correction to what long-term mortality experience is expected to be. And it's been, say they expected maybe you're going to live to 87 years. Now it's kind of been ticking down a little bit the last 4 or 5 years every time they do the improvement scale when they get additional information. The other question would be the base table. We're currently using the RP14 table, but I think there should be a strong push to use the public sector tables now, because those are more focused on employees or participants that are actually in the public sector, whereas the MP table or the RP tables are more in the private sector. So I think there's a strong push to have public sector plans to use those tables. So I think we'll talk about the change of that and what that does. One of the assumptions I did already make that's reflected in these numbers is the drop in inflation. So we always use the Social Security Trustees report, because that's like a long term, 70, 75 years. So we look at that, and that's gone from 2.6 down to 2.4. And that's a good thing, because that kind of is an underlying assumption that's baked into your salary scale as well. And there, so it kind of drops everything. But on the flip side, we kind of want to think about what we do with the investment return as well, where that currently is. And so that's in that next bullet. We're at 6.5%. As we'll see, that is very good. You're more proactive or conservative, however you want to look at that, and where you're currently are compared to everybody else. You're probably in the top 20% of using a more conservative discount rate, which is, I think, a good thing based on where your asset allocation is. So we may want to think about, should we lower down what we think the long-term capital market assumptions are going to be, where we think that the fund will actually earn, as opposed to where, speculative where it's going to be. So we'll talk about that a little bit. We talked in the last couple of years about sick time that kind of gets added on to people when they retire. Currently we're not doing anything for that. And, I think we're still in a good place. We didn't see any big swings when people retired this past year, where we had in the last couple of years prior. So I think it's fine not to do anything right now. We don't really have to. It's just, I always like to bring it up just to make sure everybody's aware of that. I mentioned the liability gains. So based on the assumptions, your contribution can really range from, I put 735,000 to just under $1 million. Last year was at 950,000 based on the final assumptions that we used. So those are some of the highlights before we get into more of the numbers things and where they all look. Any questions so far? All right. So the next few slides are just kind of a snapshot of developing, what that contribution will be. So this is just at 6.5%. This shows, what you're currently at. And the baseline is higher because it's before I incorporated the inflation change. So the next two columns with the RP 1419 mortality versus the pub mortality, those already have the inflation drop from 2.6 to 2.4, which is why they're significantly lower than the baseline. So that shows you about a $735,000 or $855,000. I would certainly probably stress that we do adopt the new pub tables. That would be my recommendation. I think that's the prudent way to go. It's more in line with where things are going. You're going to start getting pressure, and if you haven't already, from auditors, that they're going to be looking at that. The auditors tend to focus on a couple of things. the discount rate as well as the mortality table. Those tend to be the two strongest points they have. Some focus on it, others do not. But just like to make sure you're aware of that. So the next tab I show at 6 1/4. So here you're going to see 855 under the current mortality versus 980,000 roughly under the pub table. That's if so those would be the more conservative assumptions. Just like to make sure you're aware of that and where it is, everything is going. The next, I kind of show you the liability and how to change the liability, because one of our other things that we always like to bring up is how we amortize our unfunded liability. And that's kind of a key thing. And currently, the way you've been doing it is we use a 20-year open amortization. What that means is really you're not gaining any ground of closing that unfunded. It just changes every year based on what that number is and amortizing over 20 years at the current long-term investment rate. So you can see what you have. You have a 2.5 million under the current mortality, or a 3.5 million if you adopt a pub. So that then you're gonna amortize that $1 million change or all of that under the 20-year open amortization. That's what you're gonna look at, and that's a piece of your contribution that gets developed. Under 6 1/4, those liabilities are 3.5 or 4.6 million. So always something to think about. Another kind of thing I'd like to point out is that if you look at your liability split, because the plan's been closed, so what's slowly happening is your inactive liability is quickly growing to be larger than your active liability. And so what you kind of see is why I always kind of think about layered amortization is because you want to allocate the costs to the people that earn those costs, that are accruing those costs. So by doing layered, the actives going forward will have a smaller piece as opposed to trying to fund for all the prior participants that have, that develop part of that unfunded liability. The next couple of slides are just a whole bunch of numbers, but I just kind of show you a breakdown based on group, because I do know you allocate costs by group, whether it's the town, Board of Ed, or the 2 fire districts. So you can see here's the current 6.5%. That's with the current mortality table is 734,000. But you can see it's developed by group, and that's in the bottom quadrant there. And I also show that with the pub table at 6.5%. This is where you're 855,000. So you can see how it was broken up. The town portion's 450,000, 400 for the Board of Ed, and the 2 fire districts are just under 25,000 each. I think we always show this in the reports because I know that's how you guys allocate costs. Just to keep in mind that we do allocate assets based on liability, so that everybody's funded the same percentage. And again, you can see how that cost break out under 6 1/4 in the pub table. Okay. I don't know if there's any questions on any of that information. So it's a whole bunch that I just kind of dumped on you fairly quickly.
Oh. The first thing, I just want to make sure I'm reading the tables right. When we go to page 4, when we go to the pub 2010 numbers, that's actually saving those tables actually result in a less cost basis to the town. Am I reading that correctly?
No, you should really compare it from the RP19 table, RP14, the second and third columns. Those are the two. That's really the cost, because that's, like I said, those two have the inflation drop from 2.6 to 2.4, where the baseline is all the assumptions that were used as of the 19 valuation. The one change that we will ultimately make regardless will be dropping the inflation from 2.6 to 2.4, just because we kind of like to follow that report that comes out by the Social Security Administration. So it's easier.
I was just trying to make sure versus baseline, which is what we've been doing.
Yeah.
So that's what I'm looking
so yeah,
at.
You're getting a savings if you kind of look at, and that savings is entirely due to dropping the inflation assumption. Because if I left it at 2.6, those numbers would probably be 850, 855, 900, and over $1 million.
Yeah. So it's really driven by the inflation, but we're netting out. Okay.
Yep. So that's a good thing this year. It makes it a more attractive or more desirable time to make the change. If because you kind of get assumptions moving in different ways. So the drop in the inflation assumption lowers your liability, while lowering the discount rate and using the pub mortality tables kind of increases liability. So you kind of get a good offset there. And it looks like in this case, it's the inflation is more beneficial dropping that than the cost of using those other assumptions. Okay. Anything else? Next is just on the assets. You can see pretty clearly that on the cash flow side, you had more 1.8 million out as opposed to just over 1.2 million coming in, and so the assets kind of dropped. So they went down. Obviously, this is not the case currently, but again, we do measure as of 6/30, so you don't get the benefit of the market run up in the last month or so. Hopefully it stays that high, so when we do the 21 valuation, your funding level improves. Although, if you saw all these other ones, just in back, these show you at the most conservative assumption, you're at over 88% funded, which is still in probably the top 20% of all the towns in Connecticut, for funding level. So that's a very good, you're in a good position. And as you know, are well aware, we do smooth assets. You can look at the bottom line. You can see that we have 1.6 million still unrecognized losses. And when that happens, that means that your actual value, your smooth value of assets is a little larger than the actual market value. In this case, it's 105%, so 5% larger than your market value. Obviously, when we look at GASB and the numbers that go into your financial statements, they are clearly just looking at a market value. So they're just looking at that position. But for funding, you do fund on a smooth basis. Just makes it a little easier to plan. Any questions on that? No. Okay. This is just a quick chart that kind of shows you, how the market kind of swings, and which is kind of why we do smooth. So by smoothing it, your rates of return have been between the 4 and probably 6.5% range over the last half a dozen years, whereas the market's gone up and down, from as high as 11% down to 0%. So, this is why we smooth, because it gets much more difficult to fund when there's such large spikes or changes in the rate of the market value of assets. There's nothing really big in the data kind of show this to let you know where clearly, your active population has decreased, and it's only 117 people. So you had 6 less actives than you had last year. Overall, the plan dropped 4 people due to deaths. So 324 people is going to be how long the plan operates for until that last person is getting benefits. I guess maybe next year I'll add another chart that kind of shows you that, where I'll show you your expected benefit payment stream. So you can kind of see how it if it kind of increases for the next few years, and over time it'll drop off, but it'll be like over maybe 50 years or so. One of the other assumptions I like to kind of focus on is, as I mentioned previously, is the amortization, how we do that. Like I said, you're doing a 20-year open amortization. To me, that really doesn't gain ground. It's not like you're making any real ground on doing that unfunded. To me, I think a best practice would be using some sort of layered amortization. So in this case, this shows your current amortization payments $387. By switching, it would increase your contribution by about $10,000, $10,000 using a layer. Again, this is just doing. What that would be is your current unfunded that you had already at 7/1/19. You continue to amortize that over to 20 years. So this year it would be 19 years. And then any changes to your unfunded, whether it's positive or negative, be amortized over 20 years. Or you can choose another period, maybe 5 years, 10 years, 15 years. And that could be, you can isolate it due to gains and losses, and you can also isolate it due to assumption changes. Again, that's a choice that you can make. You don't have to do that. I mean, you're well funded and whatnot, and you've been doing a good job of funding the plan, but it's just something to think about. Nobody's stressing that, but it is, using layered amortization best practice, because it kind of, avoids some of that intergenerational inequity of who's paying for the benefits that have been earned. So just one of the things to think about. So that's kind of the bulk of the numbers. So I think what we need to do is decide what we want to do, in the current market, our current assumptions. Do we want to stay at 6.5? Do we want to lower it to 6.25? Do we want to lower it to change it to something else? I don't know if I don't remember if Devin put the capital market assumptions long term, but when we did this last year, using the capital market assumptions that her firm provides, and the current inflation of 2.6, we were at 6.34 expected return, long-term rate of return based on your asset allocation. With a drop in inflation, that's going to probably lower it to 6.25 or a little lower than that. So it's something to think about. It doesn't have to be, but I think, you guys should talk about it and decide whether you want to stay at 6.5 or does it make sense to drop to 6.25. I don't know what Devin's current inflation assumption is. I know most firms it's down around 2%, 2.25 even. I'm not sure she can answer that. So one of the things to think about. And as I said, the mortality table is a key one. Best practice would be to adopt the pub tables. A good chunk of our firms have already done that, or they're planning on doing it for the next valuation cycle. We'll continue to monitor the vacation sick time when we process retirement calculations and future event amortization, how we want to do that. So 2 other slides before we can go to the discussion of assumptions. So as I mentioned, we do a survey where we look at all the CAFRs that are out there and kind of look at that to see where everybody is. Devin kind of hinted at this. So from the 2019 CAFRs, the average long-term rate of return was 6.74%. And it's continued to drop down. It dropped 7 basis points last year as people, take a stronger look and get more pressure to be more prudent in what they're actually using for that assumption. Like I said, you're at 6.5, so you're probably in the top 20% of being more aggressive towards that assumption. Nobody's at 8% anymore. We did have a client that was over 8%, but for 19 they have gone down probably to 7.75 or 7.875. As most firms or plans tend to do, if they can't make a big jump, sometimes they'll do it an 1/8% at a time. We've had several of them that do that. You kind of want to figure out what your ultimate target is. Is it 6.5? Is it 6.25? Is it 6%? Where is that you want to get to? And then decide how you want to get to that point. It doesn't have to be all in one swoop because that tends to be a tougher pill to swallow, in the change. I heard a lot of complaints when the MERS plan did that. A lot of towns were not happy that they all of a sudden dropped 50 basis points because it almost doubled their contribution that they had to come up with. So it's always something to think about how to have a plan and to get to what point where you want to be. And the one other thing we show is I put it here. We have a lot more in our report. We also talk about OPEB as well. But this shows your funded ratio. Just under 90%. So that's in the top 20% of all towns, municipalities. So your plan is definitely well funded compared to everybody else. Okay. So questions and where do we want to decide on what when I produce the report in the next week or so, what numbers should we be looking at? What assumptions should we focus on?
And I'll pipe in here. So Stefan, with regard to your comment about the inflation rate, the rate that we are using is 2.4%. So
okay,
right
so
in
the same rate. Okay,
yep.
That's good.
And what I would say about our forward-looking capital market assumptions, unfortunately, we have not yet completed those assumptions. We do them at the end of the year, so our timing is a little bit off between having to make this decision today and us in the process of developing our forward-looking assumptions. Our assumptions are likely to be lower than where they have been. And that's because of a couple different factors. One is current treasury yields. So if you're looking at the 10-year US Treasury, it's yielding below 1%. So if you think about 30 to 35% of a portfolio being invested in fixed income with historically low yields. And I know we've been saying for a long time, oh, yields are so low, they're so low, they're so low. Well, they're lower than they've ever been. So the expectation of that portion of the portfolio generating any sort of return above inflation is pretty slim. And then also the fact that we've seen such a significant bounce back in equity markets since the bottom in the first quarter. Markets both domestically and internationally are up more than 60% since the low in March. So having gained so much over the course of the past 6, 7, 8 months, the expectation of continued very robust returns is a bit muted since we've seen such a strong bounce back. So I would say, although we don't have the return assumptions updated at this point in time, when we run the portfolio, our forward-looking projections are likely to be lower than what they have been historically. So that means either, you think about adjusting that return assumption downward, maybe to 6.25, or you think about adding some risk to the portfolio, maybe removing some of the fixed income.
One other point, Devin, is the portfolio makeup still roughly the same as it was for 19?
Yes, it
with
is.
The allocation. Okay. So as I mentioned, so that last year we were coming up with, based on their current capital market assumptions, was at about 6.34%. So that was a little lower. So that's just another thing to kind of think about when you make the ultimate decision of what that you think that rate should be. Thoughts? Everyone's silent.
I don't have a strong feeling one way or another. I think you can make a case to stay or inch lower again, but I think it's probably worth discussing in more detail as a formal agenda item next meeting. I know we've been consistently lowering the last few years, and great to see we're in the top 20 of the most conservative or aggressive in terms of lowering the rate. But do we feel it needs to be lower? Make sure it aligns with our asset allocation and DeMayo's CMAs or capital market assumptions. I think it's probably worth discussing at the next meeting, perhaps. And also just point out we're very well funded, which is great to see.
Yeah, and if you ultimately decide to stay where you're at, and that's fine. Like I said, I would probably lean towards adopting the new mortality tables for the public sector plans. I just think that's the prudent way to go. It's best practices. Like you may not get pressured today. You may get it soon in the near future. I don't know. I can't say. Some auditor firms delve on that. Others, it kind of take a blind eye to that. I think this wouldn't be a bad time, especially with the drop in inflation, to go to that table. Regardless of what you do with the long-term rate of return. So I think that's something to think about.
This is Jim Sullivan. I'd like to just add something. Even going with these new assumptions, going down to 6.25 and the 2.4 inflation, you see the total contribution of $895. That's $55,000 less than it was for 2021. So we can make those changes this year without feeling any pain in that specific line item for the budget purposes.
Jim, that was 9.8. 980,000, so it's up about, that would be up about 25,000. That's slide 10. That's those assumptions.
980,000. What page is that on?
Page 10, but it's also on page.
Well, page 10 isn't the total 895,000?
No, I see that number. So if you look at page 5,
that's before the adjustment. Stefan, what he's got on page, it's about the middle of page 5.
Oh, I'm sorry. So that's
if you went to 6.25 in pub, it would be 981,000. If you were 6.5 in pub, it would be 855,000. So that would certainly be lower than what you had for the prior year, which was 952,000.
Okay, I got you.
Okay.
So it's 30 more. I mean, that's still not that painful to me, in my eyes.
Well, I guess, so we've been historically conservative, which I tend to historically like. But Devin, I guess your sense of market return, or I guess Elliot and everybody else's, my feeling, I'd rather see us do the same that we've done in the past if it were up to me, and I'd take a small, eighth nibble out of it, head down to like 6.375, which, just doing quick math of looking at 6.5 versus 6.25 and seeing we're halfway that, it's still
Yeah, I think about 910,000 probably, somewhere around there.
that I got 917 when I did my quick back of the envelope math that I calculated.
That's probably better than mine. I'm just looking ballparking number, the average split. So that's what, 45
but
and 80.
it's still less than what we contributed from. Now I'm putting my Board of Finance hat on. It's less than what we contributed for the last fiscal. So there's a little bit of a savings, and it's moving us a little more conservative, which I think, what if I understood you correctly, Devin, and please correct me if I'm wrong, because I am a lot, is if we lower the actuarial assumption down, you wouldn't recommend changing any of our allocations at this time. But if we don't lower it, we may want to look at changing the allocations because of risk. Is that correct?
That's correct. Yep.
So my sense, just my personal input, is I'd recommend us taking the assumption down to 6.375 and looking at the pub 2010 mortality table would be my sense. But I am but one vote, so I'd love to hear, Elliot, what you think. And I don't have I guess kind of like Elliot, I'm not like we got to do this, but I think it makes fiscal sense and continued movement sense without making big jumps and leaps.
Yeah, I'd rather, and it's just my opinion, I'd rather take the assumptions down than put additional risk on the portfolio, if we're making a choice on those two based on where we are in markets. And I think we have, as Tim highlighted, we've done it in smaller increments, right? It's 1/8%. So we have a track record, and I guess you'd call it an expectation around that to be our course of action. So I'd probably be most comfortable with that if we're deciding between those. Again, that's just one opinion.
And Tim, I also support that. I have less of the history. I did read through some of the meeting minutes. I have less of the history than others, but I do think moving to 6.375 and going with pub would be a viable option for us to consider. I kind of agree with Elliot. Going in and adding risk to the portfolio, just given who knows what's going to happen in 2021, is probably something I would be not overly comfortable with.
Craig, any feelings?
I always have trouble finding the unmute button here. No, I think that's reasonable about not taking on more risk and sort of maintaining the status quo, essentially.
All right, so I think, Bruce, maybe you can confirm with me, do we need a motion to move the assumption down?
Yes, I would have a motion to, if you're going to change both actuarial assumptions, you can do it in one motion.
Okay.
I get a
motion.
Real quick, did we want to talk about the amortization, or we want to stay where we're at, the 20-year open? Any thoughts on that?
Yeah, I have that as a note that I'm confused about. Should we still maintain a 20-year amortization? Because what I didn't see was the age breakdown in the participants.
Yeah, I didn't put that in here. Usually it's expected working lifetime of the actives as they get older, and the plan's been closed now for 6-7 years, almost 7 years now. The 20 years is gonna start to be too long. I don't know what it is off the top of my head, but I can certainly find that information out. So it's like I said, I like to bring it up, just something to think about. You know, best practices is to kind of use a layered amortization. As I said, that way you don't get that intergenerational inequity of who's paying for the past benefits that are earned. It's like I said, once you do it, then you may have initial pain, that additional $10,000 increase, but then that'll start to wear away as 19, 18, 17 starts dropping off, and then you'll just have the change each year in the unfunded. So something to think about. If that's that's still probably, if it's 8,000 more, so that gets you probably a 9.25, which would be probably 25,000 less than your last year's budget if you do go that route.
So if I'm hearing you right, Stefan, if we go to a layered amortization, we'd still be roughly right around what we contributed to the plan last year. Maybe a little
You'd
bit
still be
more.
under with the other two assumptions that you're adopting. If you drop out the 210 and the 6 and 3/8, 375 with the layered amortization, I think that would get you to be right around 6 or 9.25 to 930, and what your last year's was 952. So that'd be a little bit less than last year's budget.
I guess personally, I think maybe a more layered amortization plan makes sense because we've got a closed plan. What are other, I guess, Stefan, what are other municipalities with closed plans doing?
Most of them, I'm going to say they're all over the map. Some do layered, some are still trying to wean them away from the open, and some do a closed. Like I had some of them that would have started at a higher for a closed, maybe 25 years. So now they're at 21 years, but that's closed amortization, so it's continually dropping. Whereas you're just kind of, so they'll catch you this year. Most of those ones, a couple of them have layered. We've been pushing more and more because that has been the best practices in the public sector, and they've been starting to talk more and more about that. How just the way it seems to be easier. It's also easy to see, kind of focus on changes that have occurred over time. So you can look back and say, oh, in 2017 we had this huge loss or this huge gain, right? Because if you get a gain one year, you're going to have a positive amortization, right? So that'll reduce the cost one year, as opposed to this, it's always going to be a charge to you right now for each change that you make, right? So because you can isolate just the change due to these assumptions, say it's not that 700,000 that I do, it's going to be a little less than that, right? Because if this is shown at 6.25. So this is going to drop down a little bit, maybe to 380, 375 or something when we look at with the portion of the charges. I think it's a good way to go, and it's a good way to see what's happened in the plan over time.
How do other members feel about keeping the 20-year amortization or going to a layered or something else?
I would default to you guys as the experts on this one.
I'm kind of in your same boat, Elliot. But I think in my personal opinion, I don't think we can keep a 20-year forever because obviously we've got an aging population in this. So.
Yeah, I mean, you're getting real close to being at the ceiling for how you would amortize.
So if it's fiscally not negatively affecting us, meaning if we don't have to increase our contributions to this, I think maybe the opportunity would be now to make that change to the layered assumption or amortization rather, and make that change. I don't know, Patty, what do you think?
Yeah, I agree. I think if we were to not do it and then we did it last year, assuming everything else stayed the same, we would then see a bump in that next fiscal year. So we'd be kind of putting off an increase for a year out. Whereas if we do it this year, given the other changes, it still comes out less. So, just trying to look ahead another fiscal year where I'm sure budgets won't be any, easier. I think it would make sense to do it this year.
Yeah, I'm inclined to take the recommendation. It's the only question would be, is there any additional thought we need to give to doing this as well as lowering our assumption as well as potentially talking about switching the mortality table that Stefan was recommending, or is that a separate conversation? Just want to bake it all in together and assess the total impact.
Well, they certainly can be all one resolution if you want to do it that way.
Yeah, I think that was kind of what Stefan was talking about with changing the inflation, changing the actuarial assumption down by an eighth, and then changing the amortization. That would still net contribution from the town to the plan would still decrease slightly. Is that what you were asking, Elliot?
Yeah, generally, yep.
Craig, any thoughts?
Again, I don't know if there's a sense of which approach is a more accurate model. It sounds like the layered approach might be, but again, does it then, create a cliff sort of at some point? So, I mean, I do think it sounds like it makes sense to use layered.
Yeah, I guess, Stefan, that'd be my question too. Going forward, what does layered set us up for, or not?
It tends to be more beneficial because you have that initial big chunk of unfunded. So we'll call it that 4 million original amount. So that's the piece you're going to get amortized over 20 years. Then going forward, each additional change of unfunded liability, whether it's positive or negative, will be amortized then over 20 years, or in a couple of years we may decide it's going to be amortized over 15 years. As that's 5 years down the road. So you're going to have much smaller incremental changes going from year to year. Think of that initial 4 million as kind of like the mortgage on your house. You know what that is, and then if you do any other changes, whether good or bad, will be a slight change in that initial payment.
Seems to make sense to me to go.
Yeah, it'll wear away. The additional cost will wear away in 5 or 6 years probably.
Seems to make sense to me then.
So do we need a motion?
We do. We need a motion to make the change to the actuarial assumption to 3.75%, make the change to the mortality table to the Hub 2010, and then to change to a layered amortization schedule.
Would you throw the inflation assumption
so
in there?
Sure.
That makes sense. That way you have the 4 changes. And that kind of, like I said, the inflation drop kind of offsets any of the other changes.
Yep. And the change for the inflation to the 2.4%.
So we can make those all as one motion, Bruce?
Sorry, I had to unmute myself. Yes, you can make them all as far as one motion.
So I'll make a motion for those 4 collective changes.
Second.
A motion, Elliot.
Craig.
Second, Craig. Any discussion on the motion? Hearing none, all in favor, say aye.
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 And I got an aye from Craig. Any opposed? State your name and that you're opposed. Hearing none, that motion unanimously carries.
So does that impact the investment portfolio and changes that should be made?
From my perspective, no, I don't think that it should. So we think that given the expectation of reduced assumptions looking forward, lowering the return assumption to 6.375 from 6.5% should allow us to be able to keep the current asset allocation profile. And then, you know, the inflation rate of 2.4%, that's in keeping with what our expectation is. So there shouldn't be any changes to the portfolio.
Stefan, was there anything else you were?
Nope, I think that's a good way to go.
All right. Excellent.
All
Well,
right,
thank you very much.
I'll stop sharing that. And there you go.
Okay, Devin, I think I've turned it back over to you.
Okay, great. So what we're going to cover next is the defined contribution plans, the 457 plan, which is currently with Nationwide, and then the 401A plan with Voya. So before I start sharing my screen, let me just kind of give you a lay of the land. So we were engaged back in 2016 to do an annual review of the DC plans. So we've been involved since that point in time. We presented our initial diagnostic in December of 2016 and then followed up in early 2017 with some plan changes. So the plans have been held with Nationwide and Voya since that time. We did do some menu consolidation and, you know, and made some improvements from that perspective. Last year at the end, in the December meeting, we had solicited and received some updated pricing from Nationwide and Voya with regard to potential plan consolidation. So rather than holding the 457 plan with Nationwide and the 401A plan with Voya, we asked both Nationwide and Voya to give us kind of their best pricing if we were to move all assets to one or the other vendor. We discussed those proposals at the December meeting and decided to not make any changes at that point in time. Vin in particular, Vin Pacilio, said that there was a fair amount of institutional loyalty to Nationwide. Nationwide has the larger plan. The plan, the 457 plan is about 10 million, whereas the 401A plan is about 1.5 million. So Vin felt that there was institutional loyalty, that participants might be, you know, aggravated or upset if there were a change to the vendor. So at that point in time, there was no decision. We did ask both Voya and Nationwide to come back to us this year, and we kind of went through the same exercise. And I think it's worth spending some more time on because and I'll go through this in the report, but when we compare the current pricing structure of both plans, they are higher than, you know, kind of the broad averages, or at least the Nationwide plan is substantially higher. And so there's the potential for very significant cost savings, which your participants would be the beneficiaries of. So although there may be a sense that folks like working with Nationwide and having the plan with Nationwide, the potential cost savings to participants, which ultimately results in a higher retirement plan balance down the road, are very significant. I know that Bruce is going to discuss the concept of, you know, fiduciary duties. I think as fiduciaries of these plans, it's important for us to not, you know, be beholden to inertia and avoid making changes simply because it creates an administrative burden or you might get a few phone calls. So I think it's important to discuss. So I'll give a lay of the land quickly with regard to how both plans are currently structured. There is one manager on terminate status within the 401A plan held at Voya. So we have a search report in the back of this report. If we decide to stick with the current plan structure and not do any sort of consolidation, we have only one of the investment options that is available to us. If we decide to do a consolidation, we have all of the options. So I'd like to make that decision last. So what I want to first talk about is the overall, the plans, and then the potential of consolidating to one vendor, and make that decision. And then we'll make the decision on a replacement small cap manager. So everyone okay with that? All right.
Yeah, I just have one question on just, I don't have the full history. What is the call it institutional loyalty that Vin was referring to regarding the plan? Is it just something that's comfort and familiarity, or is it something else? Because if it's just comfort, probably isn't worth the trade of meaningful cost directly to the participant.
Right. That's the sense, Elliot, that I got, that it was comfort. And you know, kind of, again, inertia. Hey, we've always used Nationwide. My statement comes from Nationwide. I know the rep maybe. And I think, you know, from Vin's perspective, he, and now Patty being in his old office, Vin would have been the person receiving the phone calls from participants, having people pop into his office and say, you know, why are you changing my plan vendor? So Patty, you will have to factor that into, you know, your decision. Quite frankly, our experience, and maybe folks in the town of Stonington are different, our experience has been that, you know, as long as you communicate effectively and you, the participants don't really need to do anything to facilitate the transition. It happened automatically. You notify them that it's going to happen, but they're mapped into appropriate investment products. If they don't decide to do anything, it happens for them. So I think there can be a sense of, oh gosh, this is going to cause a great upheaval and people will be really upset and I'll get lots of phone calls. And then I think that ends up actually not happening because, you know, people, it's taken care of on their behalf. So, and again, I agree with you wholeheartedly that that's not a reason to not make a change that would result in substantial cost savings.
Hey, Devin, just to add from my perspective, having gone through a vendor change in my prior role, not a municipality, and we changed both the DB and the DC plan vendors at the same time. And it's all about the change management, the communication, your detailed plan. And that's a lot of work for me and my team. But if it's the right thing to do, you know, from a plan cost perspective to participants, then you figure out, you know, how to do it. And at the end of the day, when my prior company did it, you know, there was a few little hiccups with people, but most people didn't even really pay attention to who the vendor was in a lot of cases. So I don't think it's, you know, I think it's, you know, potentially there's work involved for, you know, my department in doing this, but that's, you know, that comes with the territory. It's part of our role. The one question I will have is if we are going to look at some kind of consolidation, did we ever do an RFP for other vendors, or are we just looking at these two vendors? Because if we're going to look at it, I would prefer to do more of a broader RFP and consider a broader vendor space than just looking at Nationwide or Voya is one of the winners for it. So that would be my only upfront comment.
Yeah, that's a great point, Patty. We did not issue an RFP, but we certainly could do that, and many plan sponsors decide to go down that path. So that's on the table. Yep. Okay. Great. So let me.
Devin, one thing I'll add just
Sure.
for Patty's edification and note of two things. One was, I don't think that when we were looking at this before, the cost savings were significant at all. They were fairly close, as I remember. So the offset to the participants wasn't as great as I'm anticipating here. And we had also just mapped them through. So what I can tell you, Patty, is that Devin and the team at FIA did a heck of a good job delivering and preparing notification materials and being available for that. So we've already, through these two plans, we've already been through this once with participants, and it went smoother than I think anyone anticipated, maybe except for Devin, who knew it was going to go smoothly. But so that was all.
Okay, thanks, Tim. Helpful background.
Great. Okay, so here we go. Let me share this. And can everyone see the cover page? Okay. Great. So this is a very long document. I'm not going to go through everything. This is the plan, which is with Nationwide, which is the larger plan. This is what we call kind of the gap analysis. So we make sure that there are investment options really across the asset class spectrum, but we also don't want to have too many investment options, which can sometimes lead to paralysis. So at the time that we first began working on these plans, I believe there were something like 45 investment options. We did reduce the fund menu down. Something that's worth noting is that with both Nationwide and Voya, we are not in an open architecture mutual fund platform. We are in an annuity platform. So there are limitations with regard to the investment options that have been available to us historically. So these are kind of, you know, the best options of what we are able to access. But we do have exposure across the broad asset class and the investable universe. So we think that from a structural standpoint, the investment menus are well designed. The fund that is on terminate status is again within the Voya 401A plan, the Carillon Eagle Small Cap Growth Fund. It's a small piece of the overall assets, but we do have a recommendation for a replacement for that. One thing that I think is worth noting, so that page 6 shows the market value of assets within the Nationwide 457 plan. Within the Nationwide fixed account, we have about 36% of overall assets. And that's really the driving force which has led to the reluctance to make a change, because Nationwide did have a crediting rate of 3.5%. So there was a 3.5% guarantee that folks that put their money into this Nationwide fixed account would get that 3.5% return. And, you know, it's taking on no risk at all and generating a return that was, quite frankly, well above what other vendors were offering in the marketplace. That crediting rate has since disappeared. So they did move down to a 2.5% crediting rate, and they intend to keep reducing that by 12 basis points over the course of the 12 basis points per quarter over the course of the next 12 quarters. So really the benefit of remaining with Nationwide, which has been this very strong crediting rate, that benefit is essentially, it has gone away. I think it's important to note that 36% of the plan assets are in the fixed account, simply because even if, let's say, the crediting rate did stay at 3.5%, which it, again, is not going to, even if it did stay at 3.5%, that's typically not enough to generate sufficient retirement income when folks leave the workforce. So we really prefer to see higher allocations here within the target date suite of funds. So I think you all are familiar, but a target date fund is based on your estimated retirement date. So the 2060 fund is for a very new employee who would be likely to retire around 2060, or, you know, give or take a couple of years. So these retirement date funds, the target date funds, are in and of themselves fully diversified portfolios. The younger a participant is, the more equity exposure that target date fund will have. And then as they get closer to retirement, the equity exposure decreases and the portfolio becomes more conservative. So the benefit is that participants don't have to make any decisions themselves. The portfolio continues to evolve, and will have an appropriately structured asset allocation profile as the participant gets older and approaches retirement. So what we prefer to see is a higher allocation to these target date funds and a lower allocation to something like the fixed assets, which really, when we think about the big picture, are probably not going to be sufficient to generate the type of returns that participants need in order to have a comfortable. So with the Voya 401A plan, we have kind of a similar profile, even though their crediting rate is not as high. You still see a pretty significant portion of assets in the fixed account. And again, not very many assets in the retirement date funds. So the qualified default investment option should be the target date fund. So when folks enter into the plan, if they don't make a selection that overrides the default, they should be automatically funneled into the appropriately, the retirement, the target date fund that matches their age. So that's the overall plan review. We do have performance of all of the underlying investments. I don't want to go through each of these in great detail. I did mention that there is one fund on terminate status. We don't have any other recommendations for fund changes at this point in time. If we do decide to consolidate to a certain vendor or go out to bid and review RFPs, we will be moving to an open architecture mutual fund platform where we'll have more investment options. So at that point in time, we would probably have recommendations for changes to these underlying investments. But with the exception of this one fund, which is on terminate status, there are no recommended changes to the current investments. To give you a sense for why this fund is on terminate status, you can actually see that recently the performance has been pretty good. When you see these green lines, the green shading indicates that the percentile ranking is in the top half of the peer group. So over the course of the past year, it's been in the top half of the peer group. It's been in the third quartile on a 3, 5, and 10-year basis. It's not really performance so much that has driven us to create this terminate status. It's really a sense that, so what the manager did is they used to have a limit of 100 securities in the portfolio. And so that was their maximum exposure. So they wanted to have a fairly concentrated portfolio. They increased that limit to 150. And it was our feeling that they did that in order to be able to garner more assets. So if they kept with that 100 stock threshold, they would have become too big of an investor in their underlying holdings. And so in order to continue to fundraise and get new, people invested in the fund, have it be offered on 401k menus, that sort of thing, they raised that limit. So really they were going against their inherent investment philosophy. And that's not something that we ever want to see, is a manager putting fundraising above performance. So that's what led us to issue this terminate status on this particular fund. Both of the plans currently use the T. Rowe Price retirement date funds. We like T. Rowe. We think that that's a great target date option. The T. Rowe suite of funds tends to be a bit more aggressive as compared to the kind of broad target date universe. So they tend to have more exposure to equities than some of the other strategies. So what you can see here is on page 22, these are all of the available target date options. Basically every fund company under the sun offers target date funds. And the green line represents T. Rowe. So this is the amount of equity exposure. You can see when you have participants that are early in their career, the equity exposure here is about middle of the pack. But as you approach retirement, the target date, the T. Rowe target date suite of funds has a higher exposure to equities than some of the other target date options in the universe. And because of that higher exposure to equities, they tend to have more volatility. We think it's a great strategy. I believe that actually in our DeMayo Schneider 401k plan, we have the T. Rowe Price suite of funds, and that's what I personally use. So I'm comfortable with this, and we use it and we use these funds in many of our client portfolios. Okay, so the fee analysis, this is where it gets, we kind of get into the meat of this review. So currently, the 457 plan with Nationwide, the all-in costs are 1.46%. If we look at that on a dollar basis, based on, portfolio values, as of, I believe actually these are as of 6/30 perhaps, we're looking at about $95,000 per year. If you look at what is going to the record keeper, 1.01% is going to the record keeper, or about 66,000. So Nationwide is getting $66,000 per year from this plan. The 401A plan, the all-in cost is 1.2%. And because that's a much smaller plan, it's only $14,000. And what Nationwide is getting is 53 basis points, or just over $6,000. Okay, so that's kind of the, where we stand currently. The next few pages are detailed reviews of the fees. What I think is important is to keep in mind how your plan looks compared to other plans in the industry. So we're looking at the Nationwide plan, which is about 10.2 million, comparing it to the 401k averages book at 10 million. Your all-in costs are 1.46%, and the average is 1.05%. This is where the huge difference lies. So the weighted average investment management expense of your plan is at 84 basis points, which is lower than the average. So remember, when we first got on board, we went through that exercise of consolidating the fund menu, reducing it down, and trying to get access to the cheapest share classes available within the allowable parameters. So again, we didn't have, it's not an open architecture plan at the current juncture. So we didn't have a lot of flexibility, but where there was flexibility, we, tried to make sure that investment fees are reasonable. So the investment management portion of the overall fees are lower than what we see in the 401k averages book. But the record keeping costs, the 1.01% that goes to Nationwide, is much higher, almost double what the benchmarking shows. So I think that's important to keep it in perspective. We have put up with this, or the town has put up with this, because of that very strong crediting rate that Nationwide has offered in the fixed account. But that crediting rate has gone from 3.5% down to 2.5%, and it is going to continue to move down. So the benefit of a very strong crediting rate has essentially gone away, and now you're still looking at very, very high costs compared to the broad universe. If we look at the 401A plan, costs are much more.
Can I interrupt you for 1 second?
Yes, absolutely.
What's driving that cost? I mean, I know we looked at it before. I agree with everything you said. We looked at it, we reviewed it when we had FIA do that. What's driving those? Are those costs consistent with where they were when you did the review, and just the 3.5% was the incentive? Okay.
Yes, absolutely. Yep. Okay. They've been at this level. Yep.
Okay, thanks.
Sure. So if we look at the Voya costs of the 401A plan, and we compare this to the averages book of plans that are 1.25 million, the costs of your plan are a bit lower. So the all-in fee is 1.2% compared to 1.52 for the broad universe. Investment expenses are lower, and record keeping fees are lower as well. So in terms of the broad benchmarking, the 401A plan actually looks, pretty healthy compared to the broad book of averages. What this page 33 shows is within our internal database. So all of DeMayo Schneider's defined contribution plans, and that includes FIA and DeMayo Schneider. The total plan fee, the average is 59 basis points, and the record keeping fee, the average is 28 basis points. And this is for plans between 1 and 20 million. So you've got an all-in average of 59 basis points and an all-in record-keeping average of 28 basis points. Just a reminder, you're at 1.46 and 1.01, well above what most of our plans are at. And above for the all-in cost for the 401A plan, and above also for the record keeping. So although the 401A plan looks healthy compared to the broad book of 401K plans, when we compare them to our client base, the fees still seem high for the current structure. So does all of that make sense in terms of the fee benchmarking? Okay. So pricing considerations, what we did again is we went to both Nationwide and Voya and said, if we were to consolidate, move all assets to you, move to an open architecture mutual fund platform, what can you offer us? And this is what they came back with. So again, these are the current costs up top. So if we look at the dollar amounts, right now, you're paying about $72,000 per year in record-keeping fees. So these are fees that are going to Nationwide and Voya. If you were to consolidate to Voya alone, what they offered for the 401A plan is 36 basis points. What they offered for the 457 plan is 11 basis points. And the reason there's a difference is because the 457 plan is much larger. So you've got the economies of scale. So all in, you'd be looking at fees of about $13,000 per year. So that would be savings of almost $60,000 when we compare to the 72 that's collectively up here, and you move down to 13. That's about $59,000 in savings per year. If you move to Nationwide, the 401A plan would be at 49 basis points, the 457 would be at 24 basis points, and the all-in cost would be about $25,000. So you'd have savings of about $47,000. So substantial cost savings, no matter which direction you go in. The cost savings for Voya would be more substantial. You know, Patty, to your point, we certainly could issue an RFP, get responses from other vendors. I will say that we have much more experience with Voya. So your plan is the only plan that is record kept with Nationwide across our client base. Voya tends to be a bigger player in the space. They have more, it's not just within our firm, they have more exposure to defined contribution plans than Nationwide does have. And they've priced this very aggressively because they want the business. So, you know, that's why you see a very substantial reduction in cost.
Devin.
Yes.
So kind of seems like a no-brainer, which very few things are, at least from my point of view. I guess the only question would be, and you mentioned open architecture, would the QDIAs, the T-Row target date funds, I'm assuming they're available at Voya so they can stay in, our participants can stay in those funds, and that's where we want the majority of the investment to be. But given that it's open architecture, wouldn't an additional benefit be that our participants have kind of better access to kind of your best ideas at DeMayo Schneider, so we could align the fund offerings on the platform with what you think are best-in-class managers, as opposed to what's being provided to us off a predetermined list?
Yes, absolutely. That would be a huge benefit. And I think another thing worth noting is that this fee analysis is only based on the record keeping and administrative fees. It doesn't dive into the investment management fees, and there are likely to be significant savings on the investment management side as well, because once we move to that open architecture plan, we can, you know, identify the funds that are reasonably priced. And also you do get, so right now for one of the plans, I know both plans have the T-Row price target date funds. Those would be available at Voya with the open architecture structure. One of the plans, I believe the Nationwide plan, is in the retail share class. So they actually look pretty expensive on the investment management front. And so that's another benefit of consolidating to one record keeper, is lowering the investment management fees as well. So not only would the record keeping and admin piece of the fee go down, there's potential for the investment management fee to go down as well. So the all-in fee reduction would be even more substantial.
Fantastic.
Yep, that's great. Yeah.
Hey, Devin, one of the things that I do think this certainly makes sense to consolidate. There's no doubt. I would like to better understand from the perspective of the staff at town that has to work with each of the vendors, both the finance staff and the HR staff, maybe after this meeting, how easy each of these vendors is for us to work with. A lot of times you kind of forget that aspect of the, you think about the fees, like how difficult or easy are each of these vendors to work with. And then also to get an understanding of, how easy they are for our town staff to work with and deal with in their investments. So I don't think I'm going to be able to get that information now, but I do think this is something we could definitely look at. I mean, I'd be interested in both Jim Sullivan and Donna Devlin's perspective, because they, may work a little closer with each of the vendors. But I do think at least even just consolidating to these two without an RFP, which would be an easier thing to do, could be done in a quicker time frame. Apparently Craig seems to be on some kind of green screen.
He's got his Christmas lights up.
Yeah, really. So Jim and Donna, just interested in, your initial perspectives, since you probably in a lot of cases work more with the employees, the town staff, and with the two vendors. So.
Well, my personal experience working with Voya is it's pretty much self-serve now. They moved away from processing distributions for employees, and we had to go with a third-party administrator, the PCI, to help with those distributions. Where Nationwide, on the other hand, is more of a full-service company. I contact our representative, and they basically handle everything.
So Devin, that's an interesting point. So we need to make sure we're contemplating those costs, because we do pay another vendor separately on the Voya plan that does the distributions. That was done before my time, but that is another fee. So that's something we probably need to look at.
Yeah, I'm writing a note for myself right now. My suspicion, and I certainly will get back to you, I wonder if that's due to the plan size, and that maybe if we were to have all of the assets with Voya, that you'd get kind of the benefit of, oh, this is a larger relationship and it could be an all-encompassing service model. As I mentioned, this is the only plan that we have with Nationwide. We've got a great relationship with Voya. We have one service team that's kind of, our service team. So if there is some sort of structure in place that's making it difficult from an administrative standpoint, particularly Donna, from your perspective, I think that we do probably have a bit of wiggle room to be able to push back on them and say, hey, listen, you're not providing this service to the client. Can you, step up your game? So let me look into that. And Donna, if you can share with me, maybe offline, any additional color on, what the pushback has been, what they used to do that they're no longer doing for you. I'd like to get the benefit of your perspective.
Okay.
And Tim, just from my perspective, what I think would make the most sense is I do think this is a good thing to do and to look at. I don't think it's something my team's going to have time to do in the next month or two with everything going on with budgets and COVID and everything else. But it is something maybe we bring it up at the next meeting and then do the go forward decision at that point. And then between Devin and Donna and maybe Jim, we can do some legwork and more background work on it, and then tee it up and kind of make a go forward decision at the next meeting.
I think that makes sense. Yeah. Because I'd be hesitant from my perspective to do anything that would negatively impact the employees, because these plans are theirs. That's the thing. we're kind of the stewards of them, but my company, we set up the 401k, but it's really the employees' plan, and we just are the administrators of it. So, yeah, I would be hesitant without the buy-in from all y'all. But I think numbers-wise, I'm pointing at my screen that you can't see that I got the display up. Numbers-wise, like Elliot said, it makes total sense. But I think the little hidden gotchas are what the details are always where the devil lies. And I think already I've learned stuff from Donna that I didn't know. So good to flesh this out properly before we make a move.
Yeah.
We're in a situation we have to do anything quickly, but and if we did, we could schedule another meeting in between to just act on this item alone easily.
Yeah, I'd agree with that. And I was unaware of the information Donna shared, but I'm certainly hopeful that with the combined assets and the relationship that Mayor Schneider has, that we can probably work towards a good solution there.
One question I have is, if you're going to go and look at these two options, as Patty mentioned earlier, do you want to do a broader RFP and find out other vendors too, to see, one, to benchmark, but they may not be better than what the Voya number is, but just to see if there are other options out there as well.
Or another option is just, maybe we could just ask Devin to give a recommendation on certain firms she would recommend that we might reach out for proposals from them instead of a formal RFP.
I think if we're doing that, you probably want to do a formal RFP at that point. I mean, my view is we start by maybe looking at these two options with all the information and details. And then, Devin may have a sense from her background whether there's another key player we're missing in this. And, then we can decide. The formal RFP will push, obviously make the process a fairly long and process, but if there's another key vendor that Devin says, wow, a lot of my municipalities use blah blah and they're great and their fees are good, then I think it is worth looking at it, Jim or Bruce, whoever brought that up.
Devin, is it safe to say that Voya is already one of the preferred vendors? I'm sure with like the Fidelities of the world and T Rose and others, but Voya is already on that list.
Yes, absolutely, they are on the list. But I'll check in with. I don't do much in the way of defined contribution plans, but my colleague Scott Bolton covers that space extensively. So I'll check in with him, see if there are any vendors that might want to consider. But I know that Voya is one of the key players in the space. Great. So I think that's a good plan. I'll touch base with Donna, get some more color on the kind of the administrative hassle that's associated with Voya. We'll touch base with Voya and find out if that could be alleviated by a consolidation effort. I would recommend making a decision about that small cap growth fund. And actually, I think it's a pretty easy decision to be made, because for right now, what we'll do is stay the course with the current construct of the plan. So our only option is the ClearBridge small cap growth strategy. So with your permission, now, Patty, I saw that the meeting invite is from 9 to noon. So let me just confirm that we're not over time right now. Is that right?
Well, I thought we would hopefully be done in 2 hours, but it's probably going to be 2.5 at this point. But yeah, I set it up for that long just so we didn't get bumped out.
Okay, so I'll be very, very brief with this, and then Bruce can share his fiduciary statements. Here is the small cap growth fund search. It's at the very back of the defined contribution plan review. So right now, I mentioned that the Eagle Fund is the one that's currently on terminate status. The only option that's available to us with the current Voya structure is the ClearBridge small cap growth strategy. So here's an overview of kind of the qualitative factors of the ClearBridge strategy. This actually is a great option. We use this in a variety of clients, both on the defined contribution side as well as defined benefit, endowment, and foundation. It's a, it has 70 to 90 holdings. So one of our concerns with the Eagle Fund is that they were becoming less concentrated and therefore, not a very, very high conviction manager. So this has the kind of overall profile of what we used to like about Eagle. And then if you look at the performance on page 46, the ClearBridge Fund, if we compare, so we show the performance at the top of this table. The numbers here below this is the universal ranking. So you want something that's a lower number. Anything lower than 50 means it's in the top half of the peer group. This particular fund has been just about in the top quartile for all time frames. And then down at the bottom is the Russell 2000 Growth Index. So that's the benchmark against which we compare the ClearBridge Fund. On a 3-year basis, ClearBridge is up 16%. The Russell 2000 Growth is up almost 8%. So you have substantial outperformance on a 3-year, 5-year, 7, 10-year basis. Strong universe rankings, strong relative results. And this is a strategy that we have a lot of confidence in, and we use with a wide variety. So our recommendation would be to replace the Eagle Small Cap Growth Fund with the ClearBridge Small Cap Growth Fund.
Kevin, can you remind me how many people are in that, the Eagle? I think you showed it earlier, but how many people are in that Eagle plan?
Yes, it is not very many. It's 1.8% of plan assets, and it represents about $26,000. It doesn't tell me I don't know the number of participants, but it's a very small
Not much.
portion of plan assets. And we would just map directly from the Eagle Fund into ClearBridge.
Yeah, I mean, based on that, even if we were to consolidate and change in, let's say, 6 months, I think I would be supportive of making this change.
I'd agree with that for all the reasons Devin highlighted.
I would as well.
Also very comfortable just in my experience with ClearBridge as a firm and their team. So.
Okay, so do we need a motion for this? Probably do. Probably do. Can I get a motion to? Can I get a motion to make the change to do? Do we need to? In the motion, I guess we need to terminate. Hang on, I got to go up in my book here. Terminate the Eagle Small Cap Growth Fund in the what is that, the 401A?
Yep, 401A.
And then add and map the people to, or persons, depending on how it is, to the ClearBridge Small Cap Growth Fund.
Yeah, well, I would say, Tim, just one clarification: to terminate the Eagle Fund, add the ClearBridge Fund, and map the monies from the Eagle Fund to the ClearBridge Fund.
I like that better. Can I get a motion for what Bruce said?
Motion.
Greg.
All right, I think I had a motion from Patty and a second from Craig. Any further discussion? All in favor, say aye.
Aye.
Right. Any opposed? Nope. Okay. Motion unanimously passes.
So we'll get going on that change. Thank you.
I think I'm next on the agenda briefly before Bruce. I'll be really quick. I have nothing besides to show. But when I joined the town in July, I was told by Bruce in our official first phone call that there were 4 retirement plan amendments that had been approved, dated in 2014, 15, 16, and 19. And upon looking into the matter, it turns out only one of the 4 amendments had actually been approved, which was in 2014 and related to a COLA, which was given in 2014. So for background, retirement plan amendments require approval of the Board of Selectmen and then approval by the town, legislative body of the town, with the only exception being something required by a collective bargaining agreement or a technical change required due to change in code or law. So when we looked at the other plan amendments that were there, there is one, at least one, I think we want to move forward with, and it relates to the definition of spouse in the plan and the eligibility for the joint and survivor annuity election option. The intent has always been that this is for a spouse legally married, but it is not specifically written to exclude another non-spouse beneficiary. We've had 2 or 3 instances in the past couple of years where people have asked about having a non-spouse beneficiary covered under this, and we've said, well, that's not the intent, and then they read the plan, and they've said, well, that's not, what the plan says. So we would like to bring forward a retirement plan amendment that clarifies not only the definition of the spouse, but what the eligibility is for the joint and survivor annuity election option. I think it'll eliminate questions and concerns in the future. They may come up. There's no super urgency to get this done. Certainly, it's been hanging out there for a few years at this point. And the retirement board doesn't necessarily have to approve these, but I wanted to certainly make you aware of that one. The other one, which may be a little more difficult, and Bruce and I, may have more background. There was one that I don't know if Vin brought forward or Bruce, but it was to kind of change who could approve future retirement plan amendments, interestingly. And what it was to change the language just a little bit that said that the Board of Selectmen can be the approval, not just for CBA changes or technical changes, but it also added or any other amendment that will not result in material additional cost to the town. And I think the intent of that was to try to not make it so difficult to do a retirement plan amendment in the future by having to go to a town committee to do that. I think that amendment may be a little more difficult and it's a little gray in terms of what that, might include. But that was the second amendment that was kind of hanging out there. I don't know why none of these amendments ever moved forward or anything happened to them. Bruce had thought when I first spoken to him that they were all approved and they had not come forward. So I don't have any more background on why they did not. But definitely the joint survivor annuity election option is one I think we do want to move forward with. So I'll open it up to see if there's any questions.
I guess I'm the longest standing person on this. And I thought, much that Bruce did, I thought we had passed those because I remember talking about both of these at the time.
And we looked everywhere we could. We looked through Board of Selectmen minutes. We looked at town committee minutes. We searched everywhere we could, and they were not, I do not know why they were not approved. Don and I researched everything we could to find out, and we can find no documentation other than the COLA one that they had been approved or discussed on agendas.
I think they make sense, and as long as Bruce supports them, which I remember us reviewing it in the past, that I would still support them because I think they make sense.
Yeah, Jim, I still support them. The one thing I would recommend is, since they haven't been adopted, that we combine them to the extent we can, and that we obviously change the date to 2020 or 2021. But for those that we feel need to go to a town meeting, we keep that one separate, and those that the Board of Selectmen can approve would be another one. So basically,
I think right now, Bruce, they both would have to go to the town meeting based on the current language in the plan as I read it.
Okay.
So I think that the one amendment is to try to get it so we don't have to go to the town meeting, but we'd have to go to the town meeting with that amendment in place. So
absolutely, you would need that. So no.
And the joint survivor is not necessarily technical. I mean, we could probably look at that one, but that's not a technical change to the plan resulting from a change in the code. It's more of a clarification in the plan that doesn't exist.
Right.
So based on that, I will look to move these forward probably in 2021 at this point and figure out the steps to do that.
And Patty, I'll combine them into one and send it to you.
Okay, that sounds great. And now I am turning things over to you, Bruce.
Thank you. Let's see. Can everyone Am I sharing it? No. All righty. Let's see. Oh, there it is. I now just need to find what I want to share. Bear with me 1 second here. Can we see anything there? Can you see that now?
Yep.
Great. Thank you. WebEx, I'm not an expert at. Zoom, I'm very good at now. So let's give some background before I do this. Before, and I believe it was our May 2019 meeting, there was discussion about fiduciary duties with respect to specifically the Board of Education and their plans, and with the focus on the 457B plan, because the town obviously has turned over to the retirement board the authority to deal with investments in the 457B plan of the town, but to the extent that, but the Board of Education has pushed back on any responsibility transferring to the retirement board for any plan. So Vin had asked me to do some research and put together some materials regarding what are the fiduciary responsibilities with, in particular, Board of Education plans 457B, 403B. I did that. We were going to talk about it at the December 2020 meeting, but we never got to it. Obviously, December 2019 meeting and never got to it. So we had the May 20 meeting, didn't happen. So now at the December 20 meeting, we're getting around to that. So that's the history and background. And feel free to interrupt me at any point in time. So I'm basically going to cover three things. What's the fiduciary landscape? Who are the fiduciaries? And Connecticut's statutory rules. For the retirement board committee is the fiduciary for the 401A plan and the 457B plan for the town. You've taken responsibility for that. We've been talking about it for the last half an hour. You clearly have that authority. The Board of Education currently is responsible for the board's 403B and 457B plans. And that authority has not been delegated to the retirement board. I don't think anyone else has fiduciary responsibility except DeMayo Schneider, formerly FIA, has taken over fiduciary responsibility for giving you advice on investment funds and what to select within the two plans that you're responsible for on the DC side. But as I said, the Board of Education is still responsible for its plans, and that's not this committee's problem yet. So fiduciary landscape, little history. 457 plans have been around a while, over 40 years now. They had very little fiduciary responsibility for the first 20 years, but since 1999, all assets in a 457B plan have to be held in trust, which has to be created by the government. Your monies are held in trust. The 457B one at nationwide and add nationwide. So you have fiduciary responsibility over that. I don't know where the Board of Education's plan is, but they have fiduciary responsibility because the monies now need to be held in trust. As you know, 457B plans and you as a governmental entity are not subject to the rules of ERISA because it only applies to private sector plans. However, that legislative history has always suggested that satisfaction of the ERISA rules is sufficient to satisfy the code's requirements. In particular, the rule that really governs is the exclusive benefit rule, which is set forth in Internal Revenue Code section 40182, which also applies to 457 plans, and talks about being prudent in investments. That provision leads us to some fiduciary responsibilities for the plan itself, as does common trust law. Connecticut law, the 700 series generally doesn't apply, but the Prudent Investor Act applies because the municipality, Stonington, had to have the town approve by ordinance whatever plans it's adopted. So all the plans have been adopted by ordinance, and therefore the Connecticut's Uniform Prudent Investor Act does apply to the investment of funds. So we basically know that defined contribution plans have become more likely to have lawsuits against them. I could go through a long laundry list, especially in the 403B world right now. That's the hottest area. Start off with 401ks, went to 403Bs, and as I've said, governmental plans are next. Because as the bigger they get, the more likely they are to get sued. And the things you worry about are, one, are the plan investments good and prudent? You made a change in a fund today, clearly looking at that purpose. And then, are the fees reasonable and properly disclosed? The fees generally, need to be reasonable, and that's comparatively. As you've seen today, you have some funds, some investments with high fees, and you're looking at that and maybe looking to change that. But you should try to get fees as low as you can within reason, so long as you can still provide reasonable services and reasonable assets. It doesn't require you to have the lowest fees. It just requires you to have reasonable fees. Come on, there you go. And courts have generally looked at the process used rather than the actual result. So today, for example, what you've gone through today is the proper process to go through and evaluate funds and evaluate providers. And you've been doing that for the last 4 years at least. And the main reason why there have been all these lawsuits in the past, in the current time, is many of these plans had very deficient processes. You have very good ones at this point in time. I can't speak to what the Board of Education is doing, however. So when have they been found liable, or fiduciaries have been found liable? When the fees are not reasonable, when they failed to monitor service providers, and where they failed to follow prudent processes to evaluate. You review the funds twice a year, you review the providers on a regular basis, and you are certainly watching the fees, as Devon's pointed out in her presentation today. So I think you're doing the right things. Doesn't mean you can't be sued, but you should have some protections if you are. So in the Connecticut Fiduciary Framework, under 7-450, you need an ordinance to adopt any plan, and then that rule basically brings in the Connecticut Uniform Prudent Investor Act, which says you have to follow those rules in terms of the investment you're offering in a plan. Now, most of that Uniform Prudent Investor Act relates to things like the defined benefit plan when you don't have participant investments of the plan. But when participants control investments, the rules get a little murkier. So the Uniform Prudent Investor Act basically requires trustees who invest or manage trust assets owe a duty to the beneficiaries of the trust to comply with the prudent investor rule. You consider all purposes and you exercise reasonable care, skill, and caution. Very, very similar to the ERISA standard of the prudent person. It can be expanded, restricted, eliminated, or altered by the provisions of the trust. There's nothing in any of the provisions of your plans which change those rules at this point in time, because you're using form documents provided by the vendors and they don't touch state laws. So you can, if you look at the second bullet on this page, you can delegate investment and management functions to agents, such as the participants, their agents. However, you have a duty to properly monitor the funds that you're offering when you're not giving an unlimited universe. And you're certainly not giving an unlimited universe here. And if you take these actions, it prohibits beneficiaries from recovering against fiduciaries who acted in reasonable reliance, which I think this committee board is certainly doing. There's a long list of circumstances of things that you should consider. You're basically doing that to the extent it's applicable to the defined contribution plan. We're offering a diverse set of investments across multiple asset classes with reasonable fees and reasonable investment objectives, where participants can end up with a reasonable amount of money to retire with if they contribute enough and prudently invest those monies. And as I said before, the Uniform Prudent Investor Act doesn't necessarily apply in a normal format to you, except with respect to the defined benefit plan. And that's because you have a duty to diversify investments. That doesn't apply when the participants are doing the diversification or have that right. So let me skip this one and go to the next one. So there are employer responsibilities such as creating the plan, determining what the contributions are, designing the features, etc. And there are fiduciary responsibilities, which is what this board has taken on, administering the plan, picking the investment options, ensuring fees are reasonable. Going back to where this all started, the Board of Education plans, there is no set case law out there at this point in time challenging a 457B in their investments and their fees. And I'll say at this point in time, because there have been a few cases that have gotten around the edges of that, but so far there hasn't been any case that I've seen that has made any decisions on that. However, it can happen. This board is doing the right things on the plans it's responsible for, but the Board of Education has the same responsibilities for the plans it's responsible for. And the one suggestion that had been made, Tim, do you remember? It was probably back in 2016, wasn't it? That the Board of Education plan should be turned over to this committee to be responsible for monitoring the investments, and the Board of Education refused to do that.
Yeah, I think that's about the right timing. Yeah.
So all I'm saying here is if the Board of Education thinks that they do not have fiduciary responsibilities with respect to the plan, and they've said that they don't, I think they're wrong. So with that, I'm happy to take any further questions. And let me just stop sharing. There, we're back. Any questions, comments, thoughts?
Are you making, Craig, are you making a recommendation that the Board of Ed should do something, or requesting that we should do something? Or
I think the Board of Education should seriously look at this issue. And 4 years ago, they basically said, no, we don't have any fiduciary responsibilities and we're not going to consider this. I don't think anything's changed in the last 4 years, so I think they should consider what their fiduciary responsibilities are. And I don't represent the Board of Education, I represent the town and this board. But if someone wants to share with the Board of Education my materials, I'm happy to have them do so.
4 years ago was before I was on this board, or I was on the education board, and I don't remember really, I don't have a recollection offhand of this ever coming up as a discussion. So I'm just curious, does anyone have the history on, did we get a legal opinion, or did someone tell us, why did we make this determination? Does anyone know offhand who's got some history, or is that lost?
I don't know that answer. I can tell you, I believe at the time it was Bill King and who was the Board of Ed member? I'm trying to remember. I'll have to look back through my notes. I've got it, but the word came back that the Board of Ed felt that they did not have any fiduciary, were not abdicating nor responsible for any fiduciary responsibility. And that's when we asked Bruce to take an overall look at it to ensure that from a legal standpoint, because we were at that time also trying to make sure the town was accomplishing its and getting all of its fiduciary responsibility accomplished. So that was when we started bringing Bruce into the meetings to make sure we were looking at ours. And I think it was Bill King who brought up that, there were the other two plans under the Board of Ed purview. And did they have a responsibility? And so Bruce put, then they said, no, we're taking care of everything. And I don't know from the Board of Ed standpoint, if it was discussed, if it was brought up, that was the word that came back to the retirement board, was that, no, we don't have it. No, we've got all this going on. And so there was a perception that maybe that wasn't the case. And so I think the cautionary statement from Bruce here is that why don't you as a Board of Ed member bring this back and have a more in-depth discussion? And I'm sure Bruce would be happy to be available for something in the future. I don't know how you guys operate really, but whether you want to discuss that with Bruce so you could pass this information, then you guys could take a deeper look at it nowadays. Because I think, like Bruce said, the larger the plans are, the more scrutiny they're getting from legal people, which is unfortunate in the US, but fact of life.
Thank you. That's helpful. I guess Gary and I will see if they take a look at history and see what's there, and then come back with some suggestions or response and see what the board wants to do at this point in time.
Yeah, and I don't even know, because I think when this question came up originally, there was not a presentation from Bruce or anything like that. It was more of an open question that was brought back and the responses, as Bruce noted. So I don't even know how much from the Board of Ed side, how much history there is of discussion of this item. There might be, and I just don't know that myself. So
I don't recall any discussion ever at any time, which doesn't mean it didn't happen, but I have no recollection, and I've been on there since 2011, that we've ever discussed the pension. So again, maybe it was discussed and I just don't recall it, but I think it would have stuck in my mind, or maybe it was determined at the administrative level because someone got a legal opinion that's saying, I don't know. So, but I do think it warrants discussion. So I will bring it forward.
And Craig, and everyone else, I'm happy to participate if the Board of Education would like to talk to me.
any other questions for Bruce on this, or Bruce, anything more from you?
Nope, other than I think you're doing a fine job today.
I agree.
I'm gonna move right to the next agenda item, Patty. As I took on the role of chair as a temporary role, I will entertain a motion to appoint Patty Vermal as the permanent chair for the retirement board.
Tim, I think that means you were going to be reappointed, I think.
Oh, I got enough chairs next to my name. I don't need another one for this town.
I'll second the motion.
Sorry, Patty, we're not even asking you. All in favor?
I reluctantly approve.
I think it makes sense to have someone who is more intimately involved be the chair of this, and none of us will stop participating. That's for sure.
No, that's fine. I have no problem doing it. I've been joking with Tim on this topic for the past month or two. He did mention he had all the votes lined up to vote for me, unfortunately.
And unlike Devin, I did issue bribes, and I did make sure that I was not going to be.
Tim, I don't think you should admit that publicly.
Exactly. As the lawyer says.
Yeah.
So the last agenda topic, and Tim and I touched on this briefly, I would actually like to propose that the retirement board meets quarterly. I don't think meeting twice a year is a great option, given, our fiduciary responsibilities, giving markets, trying to review real-time data. I think our total meeting time will be about the same. It would just be spread out over 4 meetings a year versus like a 3-hour marathon meeting in December. So I do think it makes sense for this group to meet on a quarterly basis. Most retirement boards, Devin indicated most of her clients meet quarterly. The one I was on before coming here met quarterly. I just think it makes more sense from a fiduciary responsibility. And again, I think our total meeting time will not be any different. It would just be spread out over 4 meetings. So I wanted to propose that. And then I do have some proposed dates that I can either send to you separately or go over now if people are supportive of doing quarterly meetings.
I'm fully in support of going to quarterly. I think it makes a lot more sense.
I'm not opposed or nor really supported. I'm just cautious of frequency of meetings kind of incentivizing us to make more decisions unless they're right, like kind of incentivizing us to act or make decisions that may not need to be made or think short term. I just caution against that and working with a number of boards in the past. But I'm not opposed to it either.
Yeah, Elliot, I would also support exactly what you said. I don't want to incentivize us to make knee-jerk changes. And that's why we rely on Devin to keep us from doing anything silly. So I agree with the cautionary statement, but I also think that going twice a year is too broad of a look to, even if it's just a 1 hour informational, and when we hold action items unless absolutely necessary for spring and winter or whatever it is, that I still think there's with the cautionary statement, it'd be better to meet more frequent.
One suggestion I might encourage is with respect to the DB plan, you only probably need 2 meetings a year. So unless there's a major investment occurrence. So you might only deal with that at every other meeting. The DC plan is more likely to have quarterly reviews, and that's, especially out in the private sector, that's what's happening. So that's just a suggestion.
I think, Bruce, probably that makes sense. And I guess we would probably just have to handle that in the agendas, really, unless Devin brings up something that there's an imminent issue with. We could just handle it through the agendas and not a formal motion, I guess.
So if I hear that right, is it's moved to quarterly meetings, but we can have a staggered agenda where it's okay. That makes sense.
And just to put a little wrinkle in in Bruce's comment, the way that we were engaged when we were first engaged to oversee the DC plans was to do an annual review. And we have, over the past 4 years or so, we have sometimes talked about the DC plans at both meetings if there is something that has been carried over. So we haven't necessarily stuck with that, okay, we'll only do a review once a year. So I think we probably would need to amend the contract somewhat, but we can look into that. And I can provide, I don't have the contract in front of me, so I'm not sure exactly how it is explicitly stated, but I'm pretty sure that it was a one. So we can update that.
So Craig and Gary, what are your thoughts on that? Moving to kind of quarterly, potentially shorter quarterly meetings?
I have no problem or issue with that.
Yeah, that's fine. Yep, that's okay.
Okay. Now I have dates, potential dates. Is it easier for you all if I send them to you separately? I mean, and I talked to Devin with what time frame it is in which she has the results that she would need. So kind of the dates are based on that. For the most part, they would also be Wednesdays at 9 a.m. With one exception. So is it easier if I send you all the dates, or do you want to check your calendars now, or you want me to send it to you separately? Devin already checked her calendar and is free because she's obviously key to this. So if it's easier, I can send you the dates, and then you
Please.
can just get back to me, and because I have to get them to the town clerk's office this week or next week.
Yeah, can you send us the dates? That's
Okay.
what I prefer.
And can you tell us what they are too just now?
Sure. Yes. So for the quarter ending December 31st, I have 2 options just in case people have a conflict. Wednesday, February 10th or Wednesday, February 17th. For the quarter ending March 31st, it would be Wednesday, May 12th or Wednesday, May 19th. For the quarter ending July, it would be Tuesday, August 10th or Wednesday, August 18th. And for the quarter ending September 30, it would be Wednesday, November 10th or Wednesday, November 17th. and they would be 9 a.m. Generally, I think they wouldn't go much more than an hour in that case.
All of those work for me, Patty.
Yeah, Patty, from my standpoint, I'm going to have an issue on some of those Wednesdays. I have a standing meeting, which is usually the third Wednesday of the month. But if the third Thursday falls the day before, it's the second Wednesday of the month. So, strange as that sounds.
There's a higher level math problem.
There's higher level
Really?
math. So, and that meeting's always at 9 in the morning too, and that's for the state of Connecticut. So, I'll have to go through each one of those dates, but in both cases, you have a second option. So, one of those will work.
Okay, I'll send these out to everyone and then just, get back to me if there's a no in one of them.
Okay.
And then we can try to finalize that and then get it to the town clerk's office, as she's been looking for that info.
I just want to verify with Devin. I guess, Devin, you've already talked to Patty and Stefan that timing works for when you're accumulating the data and it's not too early or nor too late for our normal stuff. Because, I mean, I know we're normally in December when we look at the smoothing and that. Are we going to need to change, or does that work for both of you?
That works for me. And actually, I think it's a little bit better because the proposed meeting dates are closer to quarter end, so we won't have the issue of stale data being reported. So Patty discussed from my perspective. Stefan, I'm not sure.
I guess we'll make it work if we need to. I mean, that's, it's just a matter of timing, getting the data, getting our information from the town on a timely basis to try to meet that, that date. But we can certainly accommodate if needed.
Stefan, would it make more sense for the last meeting of the year to have that one be in December? Is that the main one that would cause you heartburn, or?
Yeah, no, I mean,
Okay.
we'll work around your schedule.
Okay.
That's fine. If the November works for you, then we'll do that.
Okay. Okay, I will get this out to everyone, then we will finalize. I think that is the end of our agenda, Tim.
Motion to adjourn. Now that you're chair, I can make the motion.
Second.
All in favor?
Aye.
Aye.
Okay, thank you, everyone. I will stop recording now. Thank you.
Thank you, everyone. Bye.
Thanks, everyone. Happy holidays.
Happy holidays.
The holidays? I didn't realize.
Bruce has his Christmas tree behind him.
Yeah.